always match the duration and the format of the financial instrument with the asset or strategy or investment behind that borrowing or the instrument, right? So if you're intending to finance your short-term working capital cycle, you need to match it with the liability that is short-term in nature so that you don't pay too much for borrowing something that you didn't need for that long. So where I see a lot of brands get it wrong is they get a long-term debt, let's say 12 months to finance their short-term inventory purchases, which is not good. It's a mismatch, right? You should never take long-term debt for short-term investment or asset.
You're listening to Ecom Finance Experts by Finaloop, where we dive into e-commerce finance best practices with the sharpest minds in the game. I'm joined here today by Val from Optimizator Financial. He's a finance partner and the growth consultant in D2C. He has great content. I love reading his stuff on social and speaking with him. Thanks for joining us, Val.
Thank you, Jacob. Always a pleasure to chat with amazing minds in the D2C space.
Okay, we're just going to dive straight in here. So someone comes to you, maybe there isn't a literal knock on the office door these days, but they reach out to you and they want you to kind of analyze their financials and help them get everything in order. What do you look at? How do you start? What do you think is the best place to begin with in this kind of case?
Sure. Typically, I always start at the foundation, which is their accounting system and the data that that accounting system stores. And then I also go to their, e-commerce platform, Shopify. I extract all the insights, put them together in a nice, presentable way that actually spits out interesting insights that we can action as part of the strategy. And then we can start laying out a roadmap for action for those businesses. So it always starts at the root, which is why Finaloop is doing a hell of a job helping businesses get things right in the first place.
Thank you. And then what would what would you say are some of the main pain points or issues once you have the financial sorted and you kind of have a better picture of where the company is up to? What would some of those recurring issues that, our listeners might be interested in kind of fixing or being on top of on an ongoing basis?
Yeah, for sure. I mean, if you look at the P&L and you start dissecting it, there is always this conversation about how do you approach the cost of goods sold section? How do you calculate gross margins, product margins properly? And there is a lot of debate about terminology. For example, sometimes the commingling happens with gross margin and product margin. If you look at the financial statements of publicly traded companies, they typically refer to gross margin as product margin, right? So it's actual cost to make product ready for sale. What a lot of D2C brands forget is that most of that terminology is rooted in the old-fashioned business, which never had, carrier fees, for example, or transaction fees. Everything came from retail, offline retail, which neglects those areas. That's why the gross margin is really product margin. But when you get to the D2C space and you start looking at it, you cannot exclude shipping fees, charges, carrier charges, transaction fees from the equation in the gross margin calculation. So that's where a lot of mistakes happen. There's you look at the publicly traded companies, you assume that they have a good gross margin or product margin, whatever it is, and you kind of forget that, well, you should be incorporating some of those fees into your calculation, or you should be expanding the calculation of the gross margin to include those shipping charges, transaction fees, and that's when you get to the real gross margin. Another thing that I see kind of butchered is the direct marketing and advertising costs. You can see a lot of businesses bundle those with operating expenses, which I typically, disagree with, because I think that marketing budget is sort of a hybrid cost that sits between variable and fixed costs, and you cannot put them in either category. It should be separated out as a third sort of contribution margin calculation, right? When we look at gross margin, it's typically contribution margin 2, and then contribution margin 3 is calculated based on the direct marketing and advertising costs, which sit right below that gross margin, right? So that's another thing that businesses forget. And typically when I come in and build the proper P&L from scratch, I look at those things and then paint a better picture of what the business actually does at the variable level, fixed level, and marketing level.
All right, that makes a lot of sense. It's an interesting point what you said before about people looking at public comps and not calculating COGS the same ways and not having. All right,
Yes.
in general, when you look at public companies, sometimes it's hard to get some of this granular data, like what the contribution margin actually is. And it's an interesting point to make. I think about that a lot about the D2C space in general. I mean, how much are people looking up at these big brands, the big names in general, or like the Hims of the world within D2C, and looking at them as some kind of inspiration, or even looking at their numbers and trying to model their financials around them. But it's definitely interesting to think about how much public comps play a role in smaller and earlier stage brands' lives.
Absolutely. I think that's part of the reason why accountants get a bad rep in the space, because they don't really speak the language of actionable insights and converting accounting data into strategy for businesses. And that's why it's kind of like, why do we even have those accountants in place? Well, we have to follow the rules to file taxes, right? But that's where it ends. But proper accountants see the difference between internal use and tax use, and they can communicate clearly and help businesses navigate both, so that you minimize your tax liability, but also come up with financial statements that are actionable and result in better financial outcomes.
Right, right. That makes a lot of sense.
Mhm.
I speak a lot in various places and forums about the cash conversion cycle. Curious to hear your take, what you have to say about it, and kind of where it meets you when you kind of are going through your
Yeah.
customers' financials.
Yeah, absolutely. I mean, something that I teach in my cohort is the cash conversion cycle and net profit margin. Those are the two key levers for profitable scale, essentially. And the moment you realize that cash conversion cycle is probably even more important than profitability is when you really change your approach to business. So if you think about Amazons and Costco's, they all have very slim margins, yet somehow they end up with huge, cash reserves that basically convert them into a bank more so than the business, right? And the reason for that is because they all operate on an amazing cash conversion cycle with negative numbers, right? It basically means that they not only do they shorten the cycle to pay their vendors, but they actually use vendors to finance most of their internal operations, and that's how they scale profitably, right? So the moment you kind of adjust to that reality and you start treating cash conversion cycle as the main lever for profitable scale, that's when everything clicks in your mind. And when you talk about fashion brands, for instance, all of them operate on 150, 200 days of cash conversion cycle because of inventory, right? Someone has to finance that gap, and it's typically the internal cash. So what ends up happening is that you need to borrow money to finance that gap. And all of that kind of snowballs into a lot of issues down the line. So where I come in is I typically calculate the cash conversion cycle in the D2C context, because the traditional approach is look at cash conversion cycle based on the balance sheet, right? So you look at your receivables, your inventory, your payables, you kind of make this mathematical calculation to estimate the cash conversion cycle, and you get your days, right? It works, but it's not perfect, because in D2C space, you also have to take into account your CAC payback period, right? Well, yeah, you bought inventory, right? You invested that cash in inventory. It took you a certain number of days to sell, and you also have to, wait a couple of days for your Shopify deposits to drop. But then you don't forget that you also have to pay for marketing, right? And marketing can end up being unprofitable for you. So you acquire customers at a loss, and then you have to look at how your LTV values of cohorts progress over time and how quickly you recoup that investment. So when you add marketing component to the cash conversion cycle, that's when you get a full picture for a D2C brand. And again, the reason why that marketing component is neglected is because cash conversion cycle is rooted in retail, offline retail space, which never had marketing, efficiency or marketing component as part of that calculation, typically. So when you combine it, you see that the cash conversion cycle can extend even further, blowing up the numbers on the back end. And most brands end up paying for all of that with internal financing.
Right. So you're saying pretty much taking all the variable costs and taking them into account. And that's especially crucial if you don't have first order profitability and need to finance that SKU until you hit the second scale or third scale, and you kind of bake that in. Interesting. Um, it's interesting. I was I talk about Costco in the past. It comes up a lot. It was actually, I think, discussed on one of the acquired episodes on Costco that if you look at their numbers, their inventory turnover is like over 12. And assuming they have net 30 terms, and they really have an unbelievable bank just of cash sitting there, which is unbelievable and really where businesses should be aspiring to.
Exactly. Yeah, and something that I can share as well along with the podcast is a matrix I've built, which again, it's not perfect, right? But there's a mathematical calculation that can estimate your potential growth in revenue within a year based on the cash conversion cycle and net profit margin that you generate, right? And you can see that optimizing cash conversion cycle can yield much higher potential in revenue growth than optimizing for profit margins sometimes, right? So you can see that matrix and make decisions based on your sort of ranges and where you sit as a business.
Right. Especially with debt prices being where they are, and if you're not managing it, needing to finance those time periods.
Exactly.
Right. There's a lot of talk now about tariffs and supply chain and where that's all going to hit us, and it's kind of taking a bit of a timeout or hiatus, which is kind of unclear where the wind is blowing. But what are your thoughts in general on this, and where can people optimize their supply chain in order to manage the business better?
Yeah, I saw a lot of debate as well. I'm connected to a couple of 3PLs in the space, and there was a lot of fighting before the announcements came out. Some of them calling each other out for spreading rumors and, all that talk before the bill passes. Yeah, I mean, it's definitely a huge risk for a lot of businesses. Um, something that I heard is, and there's actually a business called Portless, is that they actually drop ship from China, right? They operate those drop shipping facilities out of China, and they're also considering changes to their strategy and how exactly they're going to do. There's a lot of talk about switching to key areas near China, countries like Vietnam, for either repackaging or using that as a drop shipping option, which will kind of detour the ban in the short term, but of course in the long term it might be banned as well. So there's a couple of options that you can use to solve the problem in the short term. Not sure how tested those are and how long they can last. Of course, I'm no expert in logistics and expert use, but I would definitely encourage businesses to talk with Seco Logistics. Pretty good consultants in that space. So anyone needs to reach out to them, I'm happy to make an introduction as well, or you can just search them up and reach out to them. They're super smart guys, and they actually help businesses navigate the landscape. But my thoughts is that it's all politics, of course, right? And having options on the supply chain side always guarantees a backup plan when stuff like this happens. So switching to or considering options for internal manufacturing is also an option for a lot of businesses, right? So seeing, for example, there's 3PL spaces like Nimble AI, and they use fully autonomous robots to fulfill orders, which means that fulfillment is extremely affordable for a lot of clothing brands, for example. So seeing those options, there's a lot of options that are going to pop up over time that will use robotics and AI to cut the costs internally, right? And give you the supply chain options as an opportunity for savings. So playing around with those Nimble AI with Seco Logistics. So there's a lot of players in the US who are already providing solutions for that particular circumstance and to help detour the tariff ban. So I would not be concerned in the long term, but in the short term, you're going to get burned, right? So just making sure that you have a strategy in place to build those key strategic partners around your existing infrastructure is absolutely key, and you should always consider that.
Right. That makes sense. Also, one point which I saw, I think it was a post by Portless, and it's been coming up a lot. Just to clarify, is that the tariffs, if they are enacted and the ones that are in place, are on the actual cost of the goods, not on the final sale price. It's a point that keeps coming up. Just to point that out to everyone. Interesting. And how about like on the OpEx side? What are kind of some redundancies or areas where you kind of help cut costs or point out certain red flags which people shouldn't have on their P&L?
Oh, SaaS. SaaS is the biggest area. A lot of spend in ERP management, a lot of spend in analytics. There's certain solutions that need to be accompanied by experts in a specific field. So you can't just include them into your expensive tech stack and assume that that will help you generate certain insights. You need someone to come in and help you unpack all of that. So I see a lot of businesses add a lot of tools thinking that they will help solve problems when they don't, without assistance or expertise or consultants. And they just end up paying time over time, month over month. It adds up to their bill and they never pay attention to it. And they think that that will actually help them, but it's actually, a bit of a dopamine addiction. They log into the dashboard, they see numbers. Maybe they get like an adrenaline rush for seeing green on the dashboard. They feel happy. So let's continue using this app because it makes me feel good, right?
That has a lot of value. It's
Yep.
cheaper than going to a psychologist.
Yeah, I guess so. Yeah. So if you put it that way, then of course continue using it. But if you think that that will solve your problem, then of course not. So I've seen a lot of 7-figure, brands spending $50,000 a month on software, and I'm like, do you guys really need that? You can easily cut out half of that and not really experience any issues, right? That's $25,000 a month saved for no particular, change to your infrastructure. So yeah, SaaS, I would say, is the biggest category. And of course, personnel to some extent. I think that D2C as a business model was always meant to be a very lean as an operation. You should not have, dozens of people running ops and marketing as a D2C brand. If you have to rely on so many partners or on a full-time basis. I'm not saying on a project basis. Of course, you can engage certain partners when you want to optimize your retention strategy or acquisition strategy. But on a full-time basis, if you have to employ so many different partners and people internally, it seems like you lack focus and you lack direction that comes from the top, right? So you just seem to patch inefficiencies in your operations with bodies, and that never works, right? So you end up just paying more than you should. So I would say personnel always needs a close eye on operations and building out proper processes that actually are aligned with the business model. And then SaaS being secondary as well, because there's a lot of spend for no reason. So always ask yourself this question: why are we employing this tech, right? What exactly does it drive for us? If it's just a dashboard with numbers, that's not actionable insights. You can't really do anything about it, right? Maybe you should cut it out. And one of the recommendations I typically make is freeze your card for 1 month and see what kind of issues you're going to experience, right? If you feel like, oh, well, we don't have subscription for this software, but we have to make this decision that will result in, $100,000 in profit for us this month, that maybe you should keep it, right? But if it's something, oh, we forgot about this SaaS that we never used for a couple of months, then you probably never needed it in the first place.
All right. That makes a lot of sense. That's good advice.
Yep.
Now, kind of circling back to what we were discussing before about the negative cash conversion cycle. So for those who aren't financing themselves by a negative cash conversion cycle and need some kind of debt or bridge loans to get to the next inventory purchase cycle, do you have any recommendations of what kind of debt, or if you have someone coming to you and asking you, what would you recommend for, I'd say, let's say the 7-figure brand that needs financing now?
Yeah, I've spoken very extensively about this topic, and one of the key recommendations I make is always match the duration and the format of the financial instrument with the asset or strategy or investment behind that cost of borrowing or the instrument, right? So if you're intending to finance your short-term working capital cycle, you need to match it with the liability that is short-term in nature, so that you don't pay too much for borrowing something that you didn't need for that long, right? So where I see a lot of brands get it wrong is they get a long-term debt, let's say 12 months, to finance their short-term inventory purchases, which is not good. It's a mismatch, right? You should never take long-term debt for short-term investment or asset. So matching the duration and the terms is number one foundational rule. And the second thing is always sort of rate your options from best to worst. And I always start with line of credit being the best, right? Next one being term loans, short-term loans. Then third being revenue-based financing if you absolutely need it, right? Last one being credit card, right? You should never use credit cards to finance inventory because it's typically 30 days. Again, going back to the first principle, the mismatching of terms, right? So looking at those, that's how you rate them. Always start with the line of credit. That's number one rule. Always go negotiate better terms with your bank, with your, creditors, whoever it is who supplies you with capital. Always talk to them first. Get that line of credit in place. Buy yourself decent terms of 60 days, 90 days, whatever it is. And there's a lot of instruments in place like that. Like, for example, Brex used to offer this solution. They actually stopped doing that, but they used to offer 60-day rolling terms on a line of credit, essentially. So you basically buy something now, but you pay back in 60 days. Amazing terms, right? So negotiate this type of structure with your creditors, especially if you have leverage, right? If you're a big customer for them and you're growing rapidly and you're showing profit numbers, you can always go to them and get yourself the best possible instrument.
Okay, that's really solid advice. Keeping the credit cards and MCAs at the bottom, that makes sense.
Yep.
The APRs that can be unbelievable and mismatches,
Absolutely.
like you said. Where do you see this in general? Where do you see 25 going for ecom in general? Any insights there?
I'm not a Nostradamus, but let's see. Where is it going? Well, one of the biggest trends right now is AI, and AI replacing everything and everyone. I think that's very flawed, and I actually commented on Iris Finance today on the post. The founder pitched new features for the solution that basically he implied that would replace the CFOs, right? And that's how they're positioning their software in the space. What you don't need a CFO. We've built out a tool that will give you 13-week cash flow. And I basically said, look, great product, poor messaging, right? You will always need someone to come in and help you, right? And the reason for that is because if you're a founder, you have so many different areas to focus on. So your brain always jumps from one thing to another, which means that you will never have full focus on one thing, which means that there is a risk that you might oversee something, and that will cause issues for you. So I'm going on a ramp here, but it will tie back to the point about markets, right? So the reason why I'm saying this is because AI will never fully replace people, but there's AI agents that will help simplify processes and improve and make operations more efficient. So where I see is we're going to see a rise in AI operators, AI agents in different, again, areas. Like, for example, Nimble AI, going back to those guys. Huge. They just raised money at a $1 billion valuation. Insane. You can imagine what that will open up in the US, right? A lot of options. Stop looking outside, look inside with smart people coming in, capitalizing on the opportunity with robotics and AI. So I definitely see that the AI hype dying out and becoming more actionable and actually delivering value. So pay close attention to a lot of the businesses that are not marketed, but doing and building something of value in the AI space, which can help you optimize your operations and make it more efficient. So definitely explore AI agents and AI operators that will help you save time and money. Now, I would say that's the biggest trend I'm seeing in the market, aside from all the hype and all the AI, replacing humans and everyone.
Right. I think that messaging really resonates. I was just thinking about it, that in the last, let's say maybe like 2 years ago or 3 years ago, the trend within AI, when it was just kind of starting to be pitched and becoming a big thing, was that AI will replace people. And now it's more AI will augment people's jobs and allow them to perform better. But you always need the people in the back end to co-partner with the AI in order to optimize the results.
Yep, exactly.
Yeah. Okay, this has been great. It's been a lot of fun. Anyone wants to find out more about you, reach out, etc., what's the best way for them to do that?
LinkedIn. I'm always on there.
Okay.
Post every day, or try to. You can link my profile.
All right. Sounds great. Thank you so much.
Perfect, Jacob. Appreciate it.